Okay, everybody, thank you for your couple minutes of patience there. We did add a few more attendees. So welcome to the BV Capital webinar launch of the BVCAP Belton Investors LLC. My name is Ross Curtis, president of BV Capital and the national sales manager of BV Securities, and I've got the distinct pleasure of raising capital in both the Bridgeview Delaware Statutory Trust lineup, or our DST programs, through the financial advisor, and the BV Capital development deals with our partners at Bridgeview Real Estate, who are in the room with me today. Speaking of which, joining me from Bridgeview Real Estate is managing partner and founder Steve May, acquisitions director Aubrey Ennis, and developer Brandon Smith. Now, before we get started in the meat of the presentation, I do have a very few short list of housekeeping items to attend to. First of all, if you have a question, there is a Q&A box at the bottom of your screen. Please type it in there and hit enter. Don't worry, other participants cannot see who is typing what, and I'll be monitoring the inbox and reading out questions at the end for our real estate team to address at the end of the slideshow presentation. Secondly, this call is being recorded, so it will be posted to our investor portal soon after the day is over. So if you have to drop off, don't worry, the recording will be available very soon and in our investor portal at bvcapitaltx.com. Okay, now, quick reminder that this is not, repeat, not a solicitation or a recommendation to purchase any security. That can only be done with a private placement memorandum, otherwise known as the PPM. This webinar is for informational use only, and we designed this presentation to give the audience a chance to hear from the BV management team about the origin of this deal, why we think it's unique in our corporate history, and also educate on the benefits of this type of asset class. This might be a new area for some of you, and would like to tell you a little bit more about why we think this is a good place at a good time and in the right market. Hope you enjoy the show, so let's get started. Quick project overview. Obviously, Bridgeview is the team running this program with the experienced vertically integrated developer. We source the deal, we're going to develop it, we're going to property management, and then we're going to sell it. So it's in a prime location in the growing corridor between Dallas and Fort Worth that we believe has got very strong growth potential. The economics are very strong in this area between Dallas and Fort Worth. And we're going to put together a 199 unit Class A 4-story active adult development that has some exceptional amenities that we'll hear about shortly. Financials, we believe we built some conservative underwriting in place based on our assumptions and the market comps that we do have on this asset class. I spent a little bit of time about why Texas. You know, I learned very early on in my career that if you're going to be a developer, you need to build in the path of growth. Find places in this country that are growing faster than Texas. There's some spots in Florida, some spots in Arizona, sure, but Texas still leads the pack when it comes to creating new jobs and creating some positive net migration. So Texas is about to add our 53rd Fortune 500 company when Goldman Sachs officially relocates here very soon. So we're very excited about the continued growth trajectory in the state of Texas. Another one of my favorite phrases is, I wasn't born in Texas, but I got here as fast as I could. I am a native Texan. There are a few of us left for sure, but I know we've received a lot of positive net migration. Y'all are very familiar with across the Texas Triangle between the Dallas-Fort Worth area, two of the top 13 populated cities in America, down to San Antonio, which is number 7, over to Houston, which is number 4, and sandwiched in between is Austin, number 11. So you got 5 of the top 13 right here in this central Texas corridor. That's a very unique proposition for investing in real estate. But you know what? Despite this growth, we still have a bit of a housing shortage in the state of Texas. Dallas specifically has seen a wave of new construction, but also positive absorption. In fact, it's kind of defied what the analysts believe is going to happen in 2024 and 2025. We knew about a lot of new supply coming online, a lot of new doors being built, but it absorbed a little quicker than a lot of people thought. We still have a ways to go. It's not all absorbed yet, but we believe that we'll be running a little bit behind here very soon, actually. More homes are needed in order, according to Zillow, to meet the anticipated demand. In fact, they say we're about 300,000 homes short in the state of Texas, about 50,000 short in DFW alone. Construction starts have not kept up with the growth. Yes, we had record deliveries in 2024 and then 25, but it has pretty much dropped off a cliff since then as starts are way down and permitting is way down. So if people keep moving and not new stuff is being built, you're going to see a supply and demand imbalance very, very soon in the multifamily space.
Yeah, and Ross, just to jump in here, one thing, it's really obvious on the right-hand chart, you can see where we have that spike coming out of COVID 21, 22 kind of era. And you can see the time frame when then demand kind of dipped down, but construction started. That was the era of free money. And so it was very easy to get a deal off the ground. Every deal penciled, because if you have near zero interest rates, every deal works. And so what happened is, as you saw that free money, the construction starts really jumped up, and they kind of got ahead of demand. We saw softness last year in the market, and so that's what kind of mentioned that we were a little oversupplied last year. That has pretty much all been absorbed, and what you can see now is once we kind of enter into the first part of 2025, we start seeing the demand is outstripping supply, and what you're going to see is you can actually start kind of see it a little bit. That the green on the right is it's going to peak right about that last year before we had demand outstrip it, and it's going to turn south because construction starts are plummeting. As you can see on the left-hand chart, you can see that it's falling off a cliff, and we expect it to continue going that direction until we get a few more interest rate cuts that will help the supply side start kicking back into development mode. We're excited about this what we see as a imbalance in the supply-demand cycle here, where we're going to be able to step in with a number of projects. We have 3 projects in the pipe, including this one, and then we're looking to get a couple more underway next year. We think that anything that starts construction, and call it this late 24, 25 through 26 time frame, will be positioned well to be developing and delivering at a time frame when demand is far outstripping supply.
So that's the economic backdrop and kind of the state of the multifamily market today, both in Texas and across the country. But why senior housing? Is it multifamily? Is it not? It's kind of a unique sub-asset class of the multifamily generic asset class. So I pulled up a few articles recently that were talking about what's going on in senior housing today. Globe Street put a very interesting piece out talking about why they believe this is going to be, well, it already is a top performing sector in 2025, as we're showing property type returns are leading the index for the first half of 2025. And then within the sector, independent living versus assisted living. So when you think of senior housing, think of 2 different types, right? Those that need help and those that do not. The independent living, which is what we're building here in Belton, versus the assisted living. Independent living has outperformed across multiple time horizons, with noticeable outperformance extending over the last 1, 3, and 5-year time periods through the second quarter of 2025.
And just to clarify too, assisted living is an operating business. It's really not a real estate investment. Independent living is apartments for certain age demographics. So this is a real estate investment. That's a key component to this, because we are not specializing in medical. We know how to build apartments. We know how to cater to tenants. We don't know medical. It's not our field, and so we stay away from the operating business component that is assisted living or higher, or kind of there's a hybrid where they do provide meals. We have no meal services. This is an apartment complex for individuals that are in a certain demographic. 72 and up, I believe, is the demographic. 62 and up is the demographic we have for that is involved with our loan. So anybody 62 and a half, I believe it is, that wants to live in this property can live in this property, and so that's the demographic that we're catering to. But healthy, independent living folks that can manage their own, still manage their own selves and handle everything, versus something that has a medical component where there is a care element.
Absolutely. And Globe Street also noticed that net absorption exceeded new deliveries as the inventory growth in senior housing fell below 1% year over year. That hadn't happened since 2006. So they're just not building this stuff, which is why this is a needed asset class as the demand continues to grow. And that's where Jones Lang LaSalle's spring 2025 report on the senior housing asset class pretty much reiterated the same thing, that the development of new senior living facilities at its lowest level in over 16 years. Demand is picking up significantly just based on pure demographics. As such, anticipated rent growth is amongst the highest of all CRE sectors and continuing to look positive. Demographics, like I said, represent a significant tailwind for the senior housing sector, as the 80-plus age group is set to grow by over 36% over the next 10 years. So we're getting grayer.
The baby boomers, a lot of folks thought the baby boomers would exit their housing sooner. I think a lot of them essentially ran up with the housing market as it got really frothy, in 2023 and 2024. And if they didn't exit at that time, I think what you're going to see as rates start falling, there's going to be a mass exodus again. You'll see people wanting to lock in those higher prices. And so I think you'll see a lot of baby boomers and the demographic of this property start making the choice that, hey, I need to lock in my sale price on my house. I've seen great appreciation in the last 5 years. I need to lock it in because that's going to aid me as I move through retirement. I need those funds available to pay for rent and to pay for medical and other pieces of my care. So we see that this is finally the opportunity where senior living really starts kicking in, because the baby boomers are finally at a point to where they're willing to start separating from their primary residence, all at a time when we've seen a massive decline in new starts and right as demand is going to start ramping.
I attended the annual Fact Right due diligence conference 2 weeks ago now, and one of the charts from their chief economist and president was about analyzing all the different real estate asset classes, where they've been and where they might be going. So this chart has got a lot of dots on it, so follow me here. Along the x-axis is the last 15 years of NOI growth, net operating income, from 2009 through 2024, right? That's where the puck has been. The puck has been very, very positive for self-storage, life sciences, single-family rentals, SFRs. They've had very high NOI growth over the last 15 years on average. But the higher you go up on the y-axis, that's the anticipated NOI growth from 2025 to 2029, the rest of this decade. So this is where they believe things are going to be happening going forward. Now, what you don't see on the chart, because it is beyond the chart's numerical system here, is SHOP, which is Senior Housing Operating Portfolios. And they're expecting NOI growth north of 11% per year over the next 4 years. It doesn't fit on the chart because the chart stops at 7. Healthcare also expected to do well. Data centers expected to do well. Cold storage expected to continue to do well. But you can see senior housing, because it's been ignored for so long, hasn't done too well over the last, 15 years, because it's near the 2% range there. But going forward, because of lack of supply, it's going to catch up in a hurry. All right, a little bit about the sponsor. I'm sure you all know Bridgeview Real Estate, vertically integrated real estate construction and development firm between our construction vertical and our property management vertical with Welcome Home Management, and our capital markets team through BVCAP and BV Securities. We can source everything from land to development to value add to stabilization, property management, and on to sale and recycling of capital.
Real quick, Brandon Smith, who's new to the team. Brandon has senior living experience, as well as Angela Watson, who runs WH Management. And we will be bringing on a consultant who previously was a regional manager with a large national senior living facility. So we have experience in this product type within individuals on the team. BV Capital, Bridgeview Real Estate, and the companies haven't had direct experience with this field, but we do have people on the team that have experience in this field, and we're bringing more folks onto the team. So we're excited about it. And one of our regionals currently that we have within the property management company actually has experience with it. So we're slowly building out the internal teams to be prepared for the lease up on this, as the construction phase isn't much different from an apartment complex. One last thing, you see Bridgeview Real Estate there. There will be a rebranding of the holistic organization into the Bridgeview Companies. That'll be coming end of year, first part of the year, as we move towards kind of more institutional looking and structured companies, so that we kind of appeal to some more institutional investors through the DST space, as well as just create a larger, more stable platform as we continue to grow the company.
All right, a little bit of our track record. I'm sure you all have seen this slide before. We've fully realized 14 assets, returned a total of about $420 million in market capitalization dollars. Tremendous IRR returns, almost a 3x multiple, and an average hold period of just 36 months. We've got about 26 properties in our development pipeline, either currently in construction or about to be. So we're a lot of work to do to continue to keep the company moving forward. Our development record here, as you can see, these are all things that we've built. in the history of the firm or is currently under construction or about to be started, which is where you see Corinth Active Adult there, the Belton, highlighted in gray. As we've got a nice pipeline of about 992 units in construction now that will soon be available to lease, and another 1,100 in the pipeline. So again, very robust pipeline for Bridgeview. All right. With that, we're going to turn over to the property site plan and let our development team take it from there.
Thank you, Ross. Yeah, so I'm going to start off the project site, and the site plan you see here is located at 3650 Corinth Parkway. It's a 6.5 acre tract. The project will deliver 199 age-restricted units consisting of 183 apartment units and 16 duplex townhomes with an average square foot of around 1,018. The 183 apartment units consist of 99 one-bedroom, one-bathroom units and 84 two-bedroom, two-bath units, all within the 4-story main building that you see on the site plan fronting Corinth Parkway. Each floor will contain air-conditioned corridors served by 3 elevators evenly spaced out throughout the building to minimize the walking distance for the seniors. The community will also consist of the 16 duplex townhomes in the back. Each townhome consists of 2-bedroom, 2-bathroom units and a 2-car garage. The project will provide adequate surface parking throughout the community, as well as 15 detached single-car parking garage spaces to be rented individually that are located in front of the pool courtyard area. The Class A amenities and interior finishes are designed for independent seniors to separate our community from the typical Class A multifamily development. The main 4-story apartment building will feature a robust 12,000 square feet of amenity spaces versus, the typical multifamily development features around 7,000 to 8,000 square feet. The interior amenity spaces will include a clubhouse and leasing center, dining area and catering kitchen, arts and crafts room, library/sunroom, golf simulator room, theater and game room, a large fitness room with age-appropriate equipment, along with an adjacent group exercise area, and 2 saunas for men and women. There's an additional 2,000 square feet adjacent to the clubhouse fronting Corinth Parkway. There's 2,000 square feet of retail space that will be, serve tenants for our residents, such as a hair salon and a medical provider for general healthcare needs. As for our exterior amenities, pretty much situated amongst 3 courtyard space throughout the community. The main courtyard towards the front includes our resort-style pool with outdoor grilling stations, multiple social lounge areas, and privately covered lounge areas. The 2,500 square foot pool is made up of 3 different zones with a social area, lap swimming area, and a hydrotherapy spa pool. The second courtyard features an outdoor grill and dining space, a community garden, outdoor fire social lounge area, and multiple social lounge areas. And the back courtyard, servicing more in the townhome area, will feature 2 pickleball courts, a putting green, and another grill and social area.
Well, a couple of unique features that kind of are different from that you'll see in our normal multifamily deals. The townhome component is a real nice addition. We were able to kind of squeeze those into the back of the project, and what that allows for is the not quite ready for apartment crowd. If they still want something that feels more like a home and they're not quite ready to move into a luxury apartment building, that's where they have an opportunity to go there. It's kind of a shift from a 4,000 to 5,000 square foot house down to basically a 2,000 square foot house that they can kind of shrink down over time, and then as they continue to move and want less house to deal with, they can move into a smaller space within the main building. And then again, back to the clubhouse, a lot more amenities. These folks aren't going off to work every day, so they're not out of the building 10 hours a day. They're there all the time during the day, and so we've got to have as many activities and amenities. One thing we'll see later on in the financials is that we'll essentially have a lot of activities, and we'll have a lot of money that we'll spend on activating and entertaining our residents. So really cool opportunity to service this demographic with some really amazing stuff that I think will be a really just an amazing project to live in for these folks. upscale hotel quality corridors. It just feels like a luxurious hotel more so than it does an apartment building. So excited about this opportunity for this crowd.
Yeah, and then just lastly, there is a large dog park situated in the back corner of the community as well. Okay, now we go to kind of the question of, why Corinth, as Ross kind of discussed earlier. It's a high-growth suburb situated in the northern pocket between Dallas and Fort Worth along Interstate 35, which is one of DFW's major north and south traveling corridors. The city of Corinth sits adjacent to Lake Louisville, within about a 30-minute drive to Frisco, with multiple sports entertainment venues such as the Frisco Rough Riders, which is a Texas Rangers AA affiliate, FC Dallas, and the Star, which features the Dallas Cowboys practice facility. Corinth is also approximately 40-minute drive from downtown Dallas, downtown Fort Worth, the Arlington Sports and Entertainment District that features the Dallas Cowboys Stadium and the Texas Rangers ballpark. The city of Corinth is a prime location for an age-restricted senior living community, as there are no other age-restricted active adult communities within the city. Our closest competitors are located in the cities of Denton and Louisville. There's a heightened demand for luxury active adult communities within the primary market area of this site, and a current shortage of around 2,147 units, with a strong occupancy sitting just under 94% across the primary market area. Additionally, just some things that are going on in the city of Corinth itself. The project is located along Corinth Parkway, as I spoke to before, within walking distance of the newly constructed City Hall. The city has invested tens of millions of dollars into the newly constructed City Hall, along with the newly constructed Agora Commons, which will serve as the city's largest space for city events. The Agora Commons features a playground, amphitheater with stage, splash pad, and food truck court. It will host city events such as the upcoming Oktoberfest, Halloween Bash family event, car show, and Christmas family event. In addition to the nearby Agora Commons, there are multiple other nearby establishments to service the community, such as the Corinth Rehabilitation Suites, which is right across from the community, to serve the senior residents as they transition from our community to assisted living. There's also the Texas Health Corinth Hospital that's just up the road, Medical City Denton, multiple grocery stores and retailers along the Parkway District, along with the Parkway District, which is highlighted in our deck, which will be a newly built mixed-use development located at the southwest corner of Interstate 35 and Corinth Parkway, just about a mile from our community. The Parkway District is a $45 million mixed-use development to include 20,000 square feet of retail space for high-end restaurants and shopping, along with new multifamily apartments, 80 key hotel, open space, and a connection to the city trail system. All of these of which are key drivers as to why this is a prime location for active adults.
Yeah, and just from a macro perspective, active adults is a little bit different. So you got to think about your parents. Where does mom need to live? And generally where you want, and why we've placed this, or why we're excited about this location, is because this is a tweener site. And so what we're doing is we're catering to high net worth investor or individuals that want their mom somewhere nearby. So you've got great demographics in Denton. We're near Flower Mound. We're near Capel. We're near, kind of the Grapevine, even South Lake, Keller areas. These areas would have an opportunity to have mom or dad live up in this area. So it's really you want a safe community. You want a kind of a slower pace of life community. You don't want to go towards downtowns or higher density. Corinth is an amazing community for a senior facility, just because it is a slower pace of life. They are coming up with some really great amenities that are getting built nearby, but it's also very accessible and very close by high net worth investor or high net worth family areas where those folks live and have their kids or their grandkids that are there. This is a great place for mom to enjoy her quality of life and to be nearby the family without being in a more expensive zip code. So this is a great opportunity for a lot of folks that we think is poised to do well and to give good access in a good location for people to have their parents.
With that, we'll turn it over to Aubrey and speak to the sources and financing the project.
Yeah, thank you, Brandon. So talking about the capital stack, we are looking to do a HUD 221D4 program for this. For those of you that are familiar, that is Housing and Urban Development. Typically provides a higher leveraged loan in comparison to traditional finance. However, it is a significantly longer amortization period with a 40-year amortization and also a significantly lower fixed interest rate. It's interest only during the construction period. And I think one important thing to note about the 221D4 program is that while HUD does do affordable deals, they do market rate deals as well, which is what a 221D4 is and what this project is. So there's no affordable component to this project whatsoever. It comes out to about 80% to 20% debt to equity on the ratio of the capital stack. While that may seem high, HUD actually does go up to just over 87%. Currently on their 221D4 program. So we're significantly more conservative than other programs we're seeing in the marketplace. Also, you want to hit the next one there. Yeah, so again, just touching on fixed low interest rate. While we can't guarantee anything, we would imagine, I think the target for this would be a sub-6 on the interest rate, whereas you'd see traditional finance be in the 7, 8, 9% range. So definitely a bonus for cash flow to the project, and then ultimately you guys. Again, 40-year amortization, fully assumable debt, and it eliminates kind of that last point, no need for preferred equity. That usually adds a sliver of risk to the overall capital stack for you guys. Being able to do an 80% leverage deal allows us to remove the need for that at just over 12.
And the beautiful thing about it is we have no interest rate upside risk. So we all have our crystal ball. We believe at Bridgeview that we're going to see at least a couple interest rate cuts by the end of the year. Seen one already. Going into 2026, we believe that there will be more. If the ugly word inflation rears its head, and they are forced to then change path and change course and start, significantly increasing interest rates, we're protected. So the one actual positive of this financing is that as rates do go down, we can reset the interest rate on it, but they can never increase the interest rate. So if we lock in a 5.8 at close, and by the time we're up and stabilized, interest rates are 3% or 4%, we can request and get the interest rate resized on the project, which is a real cool feature. But if interest rates go to 9, we're still locked in for 40 years, a fully amortizing loan with no upside interest rate concerns.
Project timeline. 48 to 60 month hold period on this. We imagine the construction itself will be about 22 of those months. Unlike a typical apartment deal where you start, your pre-leasing processes, maybe a couple of months before the first units are delivered. This one we will start pre-leasing essentially as soon as we break ground. Given the active adult on this, typically you have a slightly slower lease up than a traditional apartment, so we want to make sure we are well ahead of that and plan on having website and full pre-leasing engaged as soon as we break ground, which we imagine is going to be sometime here towards the end of the year in Q4 of 2025 with the HUD loan closing. Just a quick breakdown, sources and uses. You guys can go through this at your leisure, but we've got about a $6.2 million land cost. As you can see, you got just over $50 million on the senior debt is what we've got projected, with just over $12 million in equity proceeds, 5 of which we have the ability to do our notes program with. Just over a $62.5 million overall total project cost. 235 square foot rents, very relatively affordable in Texas, and especially in comparison to the comps. We think that our underwriting projections, especially given the projected growth of 11% on rent here over the next couple of years, are extremely conservative, and have continued to bake those projections into our both exit analysis with conservative cap rate and so forth on price per unit.
And on that price per door or price per unit, we just did the quick math. At a 2.5 times income coverage, we've got plenty of money. You know, somebody that would be getting the max payment on their Social Security could easily qualify and be within their number. So basically, if they're I think the max payout in Social Security right now is $5,100 a month. That equates to about $2.40 rents at kind of our average apartment square footage. The townhomes are going to be more, of course, because it is truly a kind of almost a single-family rental type situation. But our average unit size of the apartments, somebody getting the maximum amount, meaning that they've waited till they're 70 to pull their dollars from Social Security, could more than qualify or more than afford these apartments. So 235 is not expensive. It's well within most people's means within the Social Security payments that people would expect during retirement.
We chatted through stabilized financial projections, building to a 6.5%, just over yield on cost at stabilization. Yeah, again, you can see there market rent comps. So today, you know, we're looking at 235. These are comps that we felt were closest to us as pulling in the market. One good thing about Corinth is the lack of similar supply in the area. I think the closest one was, I believe, the Razor Ranch area, which is quite a bit down the road. So our trended analysis at 235 is conservative for our underwriting.
And the newest, I mean, there's not many. There's a couple of these are, you know, approaching 8 years old, 5 years old, 6 years old. So, you know, being the newest kid on the block in a lot of cases really sets us up for getting the best demand coming out of existing locations as well as those folks that are selling their homes.
Sales comps, these are going to be nationwide, as you can see. So not a lot of this product trades throughout DFW. A lot of that's due to lack of supply in itself, but a lot of these folks will get in and stay there for decades at a time, so you don't see a high velocity on these. Having said that, I did check a couple of the comps that are even out there today, and they were in the 4.75 to 5% cap rate range, and that was today. So we felt quite conservative at 6.25 on an exit cap. You know, the goal would be to beat that, of course, but felt there's plenty of room in there for us to outperform. And then, you know, an exit occupancy of 92%, that's $251 a square foot. That's, you know, in our year 5 rental range, which again, with rents where they are today and the projected rent growth, that's, I hate to keep using the word conservative, but I think that's a easily attainable goal to hit that $251 a square foot on exit.
And then one thing we do that's, you know, we try to be, you know, overly conservative on one, if not multiple metrics. You know, we realize that a lot of these transactions that as we you know, move to exit, cap rates could be better or rental rates could be better. And so by being this conservative on the cap rate, we have plenty of room that if interest rates weren't, if rental rates were softer than what we underwrote to, where we see the market in today's world is a significantly tighter cap rate range than where we're underwriting to. So lots of wiggle room in this. If they all perform better than we've underwritten, then we end up with just an amazing opportunity on an exit. But worst case, if one slightly underperforms, we've got enough cushion with the cap rate or even with the rental rate that we're not putting the investment at a deficiency going into a sales cycle. We think actually we've underwritten it conservatively, and if the market pans out the way we expect it, that we see really strong upside in this transaction.
All right. So there are multiple ways to participate in this offering. We talked about the equity versus the notes, whether you be an equity investor or a debt investor. There's also what kind of account do you want to invest in, whether it's a non-qualified account or a qualified account. A lot of investors in our development deals like to invest in their traditional IRA, whether it's from rollover funds from an old 401k that they put into a self-directed IRA, take advantage of the backdoor Roth IRA conversion at a discount. That is a mouthful. Let me explain a little bit what that is and what it looks like and what the benefits of it are. Because in this example, if you start from left to right on this graph, you'll see an initial investment of $250,000 into this deal, hypothetical deal that's supposed to last 3 to 4 years. And of course, the Belton's case, it's 4 to 5. But still, once the last bit of money is raised and the development is underway and the deal is closed, what we do is work with a third-party evaluation firm to revalue the value of the investments. And that $250,000 can shift downward because of all the illiquidity costs, the capital costs, multiple costs that brings the value down. Then we work with each IRA custodian of our investors to revalue that amount from 250 downward to somewhere usually between down 30 and 32%. In the New Braunfels project that we are currently almost starting to lease people in and finish construction, we lowered the investment amount by 32%. So $250,000 investment worth around $175,000. Now that shows up on your traditional IRA statement. So what you have the ability to do is move that money from your traditional to your Roth IRA at that lower basis of $175,000. And then when the New Braunfels property is sold one day, and you get the full value of that property back, but the money is now inside your Roth IRA, which makes it tax-free for life. So you can move money over in the short term, pay less in tax due to the reduced basis, thanks to our development project, and realize all the upside inside your Roth IRA account. And the other good thing about this is, part two, is that you don't have to do the conversion all at one time. These projects aren't built overnight. Like he said, it's going to take 2 years to build this program. So there might be 2 calendar years of which you can move the money from your traditional to your Roth and not pay the tax and all in one conversion transaction. You can convert some in 2026 and maybe some in 2027, depending on where you're on the construction timeline and the revaluation timeline. So it's a very, very good opportunity for those of you who would like to have more money in a Roth IRA and less money inside the traditional IRA. Because as we all know, traditional IRA, when you take money out, is taxable by the IRS. In the Roth IRA, it is not. So that is the Roth conversion at a discount opportunity that our development deals at Bridgeview provide. All right, in summary.
You guys can read on the screen the summary piece. Due to time-wise, we're going to go ahead and kind of jump quickly into Q&A and answer a few of these questions that we've got out there. One question real quick is, how much is Bridgeview Multifamily investing as an equity partner? We generally do between 5 and 10% of the transaction as a co-invest. So we do contribute to our own transactions and have our own money in there. So we will have a capital at risk alongside you. Let's see here, some supply-demand charts, specifically the Dallas MSA. We might have some of those. I know there is more information in the PPM, so I would direct you back to the PPM, and if there's not sufficient there, please feel free to reach out to us, and we can look at some more stuff for you. What is basically, it's a question about the senior housing and how does it contrast with the SHOP, the senior housing. They're the same thing. So the triple net senior housing and the senior housing that were on the chart that showed the 11% growth, they're the exact same thing. That is just, it's basically age restricted apartments. And so that's what both those nomenclatures are the same thing. All right. Do we plan to sell the development after it's complete or rent it out the units and manage them? So we will essentially build the property. We will rent the units. This is a little bit unique in our compared to what we do in the past. With multifamily, we usually don't start leasing until about 6 months until we open. So it might take us, 12 months to be under construction, and then 18 months total to build it. So after a 12-month period, we'd start really gearing up the leasing effort. Because the leasing cycle is a little bit longer with senior housing, we will start leasing the day we start construction. So we will have website, all of our marketing material and everything else up and teed up and ready to go, so that day one we'll be on our manager or a leaser sooner with this project, just because of the way it is. We'll be leasing essentially day one on this project, because it is a little bit longer lead cycle, but with smaller number of units, with only 200 units, we expect it to go, rather quickly based on where the supply-demand imbalance is. And so then once it's stabilized, we will sell the property at that point in time. Let's see here. Will there be a lifeguard at the pool area at least part of the time? No, there will not. It is a shallow pool. It is not, it'll probably be 4 feet deep at its deepest. I don't expect, there will not be a high dive or a diving board for these folks. It'll be more just a kind of a waiting lounge type pool. So that's really what it is. So we will not need a lifeguard, and we do have the appropriate signage and everything there that is necessary to do that under Texas code. Let's see here. Due to the HUD loan, wow, we've got a sophisticated question here. Due to the HUD loan, will a REAC inspection be required annually? So it depends on how you do on a REAC. If you do really well, which on our last REAC we had at Carriage Homes, which is a HUD deal, we scored in the 90s, and therefore we were exempt for 3 years. So we've always, on all of our REACs, I think the lowest we've ever scored is high 80s. And so that's a 2-year window. And so I think that's what we've gotten to. So let's see here. Rent premium relative to comparable non-senior living properties, and if so, approximately what percentage? These usually rent for I'd say about 20% more than a traditional apartment complex. And really it's related to the amenity package. The amount of things that, in a property this size, if we just built an apartment complex, we would not have all the amenities. We wouldn't have golf simulators. This has 3 elevators. For a property this small, we would probably try to get away with 1 elevator, and also air-conditioned hallways. So this property has got a lot of things that we wouldn't add in a typical market rate apartment deal. And so that 20% is well justified and supported in the amenities that we're offering there. So let's see here. This one is the luxury property. What percentage of general target population project would candidates be able to afford? That's back to the affordability piece. Again, anybody that's getting the maximum amount out of Social Security, which doesn't take a lot of income these days to max out Social Security. I think it's a little over $100,000 to $120,000 a year in your highest 3 tax years, I think is what gives you the potential. And if you wait till the latest date you can max out Social Security. So we feel like that this demographic, it's basically an income number of around 70,000 is what the average person would need income coming into their retirement age to be able to afford this at a 3x multiple. If we went down a 2x multiple on rent or income to rent, it would be down to in the 50s. So somebody that has income in their retirement from $50,000 to $70,000 can afford to live here. And let's see here. Roth conversion. Yeah, please give us a call back if you have more questions on the Roth conversion, as we're really running out of time here. Number of years, more Roth conversion questions. Let's see here. What impact other local projects online? There's no other. We're not seeing any other senior deals in the market. There are some multifamily deals that'll be around us, but no other senior deals. And so we're blessed there that it's just us in the marketplace. Yes, future supply. There's really not. There's nothing coming up anywhere near us on the senior housing front. Let's see your self-directed, more IRA questions. Please reach out to Ross and his team about those. And then sales comps around the country. This is all the sales comps we've got in the last 9 months, 12 months. There just hasn't been a lot of sales comps that are supported. There's just not a lot of these that get sold. A lot of properties in this demographic or in this vein of multifamily are owned by institutional owners, and they just don't sell them. And as you see from the data and the demographics and the information that's coming in these, a lot of people are really holding on to these things, making them more efficient and just ready to ride the wave. So the sales comps have been harder to come by, particularly here in Texas with the demand that we're seeing. What are the assumptions for retail? Aubrey, what rent number are we looking for that?
$40 a foot.
$40 a foot, that's all in, triple nets and everything.
Yeah, it comes out to about 80,000 a year, so call it 70 to 75,000 on an annual basis.
Yeah, it's in line with local comps, so it's $40 all in, including triple net. So that's probably about a $28 rent plus about a $12 triple net. And we feel like the demand for this will be high just because of the captive audience we have there. So let's see here. What are the other revenue sources chargeable to the tenant? We do a lot of stuff. We're actually moving into some unique stuff in that we have moved to where we do a flat fee for amenities and water and things like that, so that now most of our properties, water bills are becoming a profit center, whereas if you do an actual metering or a RUB system, you end up having slippage of anywhere between 10 to 25%. There will be trip fees. There's a lot of additional fee income that comes with the senior housing facilities. But generally, the way it breaks down is you'll have some type of premiums, whether you got a view of the pool or different things. We'll have kind of an amenity fee that will be charged per month to just upkeep all the amenities, the golf simulators and everything. There will be kind of participation fees that'll cover the cost of shuttles and things like that for folks. And then they'll have their utility charges and that get charged back as well. So that's the other fees. And looks like that's the end of the questions. Again, anybody with IRA questions, please follow up with Rob and his team. We appreciate you. With Ross and his team. Appreciate y'all's time today. Thank y'all for reviewing this, and we really are excited about this opportunity. We are moving rather quickly. I think we're well over 50% subscribed.
50% subscribed and 2%, 2 million funded.
2 million funded.
Yep.
So this will move quickly. If you have an interest, please call your rep and get your queue in line. Again, thank you for your time. We appreciate all you guys, and we hope you all have a blessed week.